Now we will review 3 objective test questions in the question bank. First question to be reviewed is question 2. It is a descriptive questions. You have to show your understanding about the statements, which are the correct statements here. First of all, look at statement 1. Statement 1 say an increase in the cost of equity. The cost of equity increase is to the 4 in share price. Is this correct? Okay, let's see. Given the cost of equity increase, it implies the WACC, the weighted average cost of capital increase as well, because WACC equal to the cost of capital. Okay, and for us, for example, if we use the discount cash flow model, when you increase the cost of capital or the WACC, in other words, all the net present value will be going down. And given the share price reflecting the NPV of the company's cash flow, okay, so if the net present value drops, it means the price drops. So in other words, in this logic, when the cost of equity going up, then the price drop, the share price drop is true. So the first statement is true. Second, investors faced with increased risk, okay, will expect increased return as compensation. For the risk increase, okay, for the risk increase, if we are applying the capital asset pricing model, saying that it measured, we kept the formula, it is the risk-free rate plus beta of a company times the equity risk premium. Okay, the beta, which can be considered the systematic risk. The systematic risk. So when the risk increases, the beta increases as well. And then here, the cost of equity also going up. And so what's the return? Cost of equity is the required return by the shareholders, right? So in other words, the return increases, compensation is true. Okay. For the third one, it's about the cost of debt. It's usually lower than the cost of preference shares. Okay, we have to recap. It's about the creditor hierarchy. And for the cost of debt, it should be the secured debt or unsecured debt. Okay. And all these have a seniority or priority versus preference shares in the financial claims given the company is in liquidation. Okay, here is the creditor hierarchy. Once the company is in liquidation, the financial claims, okay, the financial claims against the companies under liquidation will be, first is the secured debt, next is the unsecured debt, and then followed by preference share. Last one is ordinary shares. So for the secure debt and unsecured debt, in general, they are requiring lower return as compared to preference share and ordinary share. Okay, so the cost of debt is generally or usually lower by these two categories, the debt as compared to preference shares and ordinary shares. So in other words, this statement is, because it's lower, is correct. So the answer should be D. 1, 2, and 3 are correct statements. Okay, next question is again asking you to check which statements is or are correct. Okay, let's look. The first statement, the asset beta reflects both business risk and financial risk. Okay, for the asset beta, you have to check your formula sheet. Asset beta equal to what? Equal to the weighted of equity beta plus the debt beta. Okay, it is equal to the equity beta and the debt beta. For equity beta, it reflects both financial risk and business risk. For the asset beta, okay, for the asset beta, it is an ungeared beta. Okay, it only shows the risk of the asset it holds. Okay, only show the asset, the risk from the asset, and it doesn't consider any financial or capital structure. So in other words, the asset beta only reflects business risk. It doesn't reflect financial risk because it is not considering the capital structure. So in other words, the first statement is not correct because there's no capital structure or financial risk is considered under asset beta. Next, total risk. Total risk is the sum of systematic risk and unsystematic risk. Is true, definitely. The definition of total risk is here exactly the sum of systematic risk and unsystematic risk. And the third one, assuming that the beta of debt is 0, will understate financial risk when ungearing an equity beta. Okay, we have to check from the formula to see whether assuming the beta of that is 0 will understate or not, will understate financial risk or not by ungearing an equity beta. Here, the formula, okay, we just check here. If the beta, that beta is, say, for example, here is 0, then the beta, the asset beta divided by the value or the weighting of the equity value all right, assuming here this monster, for example, is 0.8 and the asset beta is, for example, is 1. So the equity beta will be 1 divided by 0.8, which is 1.25. And if the debt beta is not 0, for example, is 0.1. So what's the consequence? Okay, and here should be 0.2. Okay, so 1 minus 0.02 divided by 0.8 is the equity beta. So it is 1.23. Okay, so from this example, I'm showing you if assuming the debt beta is 0. Okay, here the differences is from the financial risk. Is from the financial risk because the asset beta or the business risk should be constant. Okay, the differences here between the A and B. Okay, the 0.02 is the financial risk. We can see that for the debt beta, if it is 0, the financial risk is overstated. Okay, it seems not understated, so it's wrong for the third statement. In other words, the answer is A, 2 only. Okay, I would like to use the proof showing how to get the answer here. The last one is a calculation. Is a question asking you to calculate the after-tax weighted average cost of capital on the market value basis. This company, GFVCO, is financed 70% by equity and 30% by debt. The company has an after-tax cost of debt of 6% and an equity beta of 1.2. The risk-free rate of return is 4% and the equity risk premium is 5%. Okay, given this information, please work on the weighted average cost of capital, the WACC. We got the after-tax cost of that is 6%. So in other words, we need to find out the cost of equity first. Okay, in this question, there's no dividend information provided and no dividend growth rate information provided. In other words, you have to use the capital asset pricing model to work on the cost of equity. All right. So here we got the risk-free rate is 4% plus the beta, the equity beta is 1.2 times the equity risk premium, which is 5%, is from the column. So you can work at 4% times 1.5% times 1.2 plus 4%, which is 10% cost of equity. For the WACC formula, which is the equity market value divided by the total company's value times cost of equity plus the weighting of the debt times the after-tax cost of debt. Okay, here all numbers are we get, okay. So we can get the weighting is 70% times 10%, which is the cost of equity in the weighting, plus the after-tax cost of debt is 6% with 30% weight. So the WACC here is 0.8%. So the answer is D.